Discount points and loan fees are additional charges that are added to the cost of getting a loan, and they're paid by the borrower up front. But it's important to understand what points and fees are and why they are included as part of the loan. Points are 1% of the loan amount. It's basically adding to the rate. And what discount points do is they allow the lender to capture some of their yield up front at the beginning of the loan. The reason they're called discount points is because the borrower doesn't pay them to the lender. Typically, the lender just deducts them from the loan amount. Lenders don't necessarily need to take the extra step of having the borrower give them a check for the point, and then they cut a check to the borrower for the loan. They just deduct the point from the loan. So that's why it's called a discount point. It's discounted from the loan balance. Fees are charged by the lender typically to cover their origination costs. Lenders have staffing costs for people like underwriters, processors, and fees allow the lender just to recoup some of those costs. But here's what's important to understand about points and fees. They actually increase the borrower's cost of capital. Let me show you an example. Imagine we have a $1 million loan at 6% amortized over 30 years. But the borrower has to pay 2 points plus $8,500 in fees. Here's the effect of adding the points and fees into the loan. A $1 million loan at 6% for 30 years would have a $59.95 payment per month. But because the lender discounts the points and fees out of the loan amount, the net cash that they dispersed is $971,500. So the borrower still pays a $59.95 payment, but they only actually received $971,500 in cash as their loan proceeds. Well, when you solve for rate on that with a 30-year amortization, the actual cost of those funds is 6.27%. And that's if the borrower holds the loan for 30 years. When the borrower holds the loan for less than 30 years, the effect on the actual cost of funds to the borrower is even greater.